Hello and welcome. You are tuning into the Wild Bat podcast. This is episode 3, where we are going to be talking about module 2 of the income tax course, the principle and practice of integration. And yes, we're talking about tax. Let's get into it. So when you start if you start a business, you have the option of either incorporating and having all your operations run through a corporation or a company, or you can just have it on the side and report it on your personal tax return as a personal venture. If you decide to incorporate, there are many tax benefits. You can retain the profits within your corporation and not distribute them to yourself. Also, there's other things such as limited liability, the ease of selling your shares to other people, and it's the benefit of having your operations owned by a company rather than owned personally creates that little divide, which may make things a little more simple. But the problem is we tax both corporations and shareholders, and this can cause a problem. Let's look at this scenario here. Hypothetically speaking, just say you're started your business and you've made $10,000 worth of profit. You can either run the profit through the corporation or as a sole trader. The scenario is going to be exactly the same. $10,000 is made. It doesn't matter if it's incorporated or not. If you have incorporated, you will have to pay 38% base tax. You're going to get a 19% small business deduction, plus minus a 10% abatement, and then also have to pay Alberta financial tax of 2%. This will give you a corporate tax rate of 11% under this scenario. Your corporation will have to pay $1,100. That means you can distribute dividends to yourself of $8,900. Your personal taxes, this is based on a tax bracket which is over $48,000, and the lowest Alberta tax bracket, which will result in a effective personal tax bracket of 30.5%. That will mean that you will have tax to pay of $2,714.50 personally. Your total tax to pay for the year is going to be $3,714, giving an effective tax rate of 37.14. However, if you didn't incorporate, well, you don't have to worry about the corporate tax. You don't have to worry about dividends. You only pay personal tax on the total income, meaning you only pay $3,050. So, from here, it looks like, what's the benefit of incorporating? You're just going to have to pay tax. You know, the benefits of having unlimited liability, selling your shares, it's not worth it. Well, let's look into this. The problems of double taxation, they result in the economic benefits not being retained. Now, in the economy, we want corporations to happen. They're amazing vessels for creating new ventures. A lot of big organizations use them. A lot of small business owners use them. They're really great. You don't want a tax cost ruining the concept of incorporating. The corporations need to be taxed. If they're not taxed, then all the earnings can be retained within the company and never distributed, and hence never taxed. The shareholders also need to be taxed. The way I like to see it, profit and taxes are always paid inherently at a personal level. If Because people are the ones that make the money. People are the ones that run the businesses, that are the shareholders, that are the buyers and the sellers. So hence, the shareholders are the ones that have to be taxed. Corporations, well, we'll get into that. And if there is any tax cost to the integration, it needs to be very minimal. So let's look at how we can create this integration. How about we don't have a corporate tax rate? You just tax the shareholders, and because the funds get generated and retained within the company or the corporation, when they get declared, they will get taxed. So, I mean, there's going to be a tax deferral occurring, but it's not like they're never going to get taxed. Unfortunately, tax deferral can get quite significant. I don't want to get political, but it's probably the reason Donald Trump only paid $750 of taxes during one of his years. So that may not work. Let's look at the second approach, where we tax the corporate tax at the highest personal rate, and then we allow a deduction for dividends. So when I say deduction for dividends, what we're going at is when you have expenditure, legitimate expenditure, you can deduct that from your income to create your net profit. Well, we could do the same for dividends. Just deduct the dividends from the income and you would create a net surplus. Well, that could work, but the problem will be is that there will be this concept of tax leakage, where some of the shareholders will not pay because they're non-residents or they're other companies. Now, this has happened with some tax schemes where one entity declares a distribution to another entity, and because of the misalignment of the tax years, or the way that income is sometimes deferred, the tax liability keeps getting deferred on and keeps getting kicked on into the future and never paid. If you know anything about time value of money, this is a really amazing loophole which has been taken advantage of, but do get closed up because of that reason. All right, how about we distribute the dividends tax-free? Well, that could also work, the dividends, the shareholders wouldn't have to pay. The shareholders wouldn't have to pay tax on their dividends that they receive. The company still gets taxed. However, the problem is there's this concept of a tax cost that would occur. How corporations are taxed at, taxed at one rate, or at multiple rates actually, but not as but it's a different strata of income bands compared to personal. For example, your first, all your income that's subject to the SBD, in my other example, had an effective tax rate of 11%. However, without the SBD, that income rate would be higher. However, compared to your personal tax rates, your first, I think it's up to 48,000 is taxed at 10%, and the next tax, and then the next tax band is taxed at 17.5, and then it goes on and on. Because of this misalignment, this results in a tax cost or a potential tax cost, especially because the corporate tax rate is generally lower than the personal tax rates. So how about we integrate corporate and personal taxes via grossing up and tax credits? Well, that's what we're doing, which I'll get into in the next slide. So how we do this is we adjust the dividend based on what tax they had to pay, based on if it was subject to SBD, and then we provide a dividend tax credit so that the Canadian taxpayer can receive a benefit for the tax that was paid on behalf of the income that was taxed in the company. Join me on the next slide where I will show you how we do this. All right, welcome back. I would just like to give a shout out to IPEVO. They've provided me, I purchased it, a VZ-R document camera, which is a very great overhead camera. I will put a link in the description. So this is going to be a really good, I'm going to go through the same scenario, except we're going to be talking about how we are going to gross up and apply dividend tax credits and how we do it. So if you look at the scenario I had before, it's exactly the same, except I haven't filled out the corporate side, and you'll see why. So the first step, everything's the same down to here. However, then we have to gross up. And this is grossed up at 15%, with the assumption that this is non-eligible dividends. So we gross up the dividends 15%, which is this. So the personal tax now of 30.5% of our 10,235 is $3,121, give or take. And now, we haven't deducted the dividend tax credit, which we are going to do now. The dividend tax credit is 10.38% of the dividend, of the non-grossed up dividend, which you are going to reduce from that. So if we add on our corporate tax plus our personal tax minus off our dividend tax credit, we get $3,297.86, which have earnings of $6,702 and an effective tax rate of nearing but not quite 32%. In our prior example, we had to pay taxes of $3,714, which means we do have a tax saving due to this gross up and then tax dividend procedure of $416, which has created a bit of alignment between the effective tax rate and the corporate scenario compared to the sole trader scenario, but it isn't quite aligned. We'll go back to PowerPoint where we will discuss how perfect integration can be achieved. So as you can see from what I had on the scanner, is that integration wasn't quite achieved. For perfect integration, if we had fully taxed income, meaning there was no small business deduction applied, our gross up would be 38%. Now, if we had an average tax rate of the corporation at 27.53%, and then the dividend tax credit would be 38%, perfect integration will be achieved. So in my example, just go through some of the reasons why it was different. I used the lowest corporate tax rate possible with the SBD fully applied. We only distributed non-eligible dividends, which were grossed up at 15%. Our personal tax bracket was over the 48,535 mark for federal tax, and it's in the lowest Alberta tax bracket. All right, let's move on to tax deferral. The benefit of if your corporate tax rate is less than your personal tax rate, then this creates your tax deferral component. If you are a high earner, where you have a job that makes a lot of money and you have a business on the side, you don't want to distribute your dividends from your business on the side, which is incorporated, to your personal tax return until you need to, for the reason that the corporate rate, although you're going to get taxed on it, the retained earnings in your company will remain there, and if you distribute them as dividends, they will be taxed at the highest personal tax band that you're in. However, if you have a corporation which makes a lot of money and you've either exceeded your small business limit because you've gone over the $500,000 limit, or it had to be applied to other businesses, a tax cost can occur, which is something to be mindful of. All right, that's all for now. Thank you for tuning in. Join me next week. I'll hopefully get out module 3, which is going to talk more about the business limit and association. Thank you for tuning in. Have a good night.